Hey there, have you ever pulled up a financial chart and just felt completely lost? Like you're trying to read some ancient coded language? Well, if that's you, you're in the right place. Today, we're going to decode the absolute essential terms in Forex trading. The goal? To help you stop feeling confused and start understanding what the market is actually trying to tell you.
Yeah, that feeling. Your eyes just kind of glaze over when you see all those lines, numbers, and weird acronyms for the first time. Trust me, we have all been there. It's pretty much the first big hurdle for anyone who's curious about trading.
But here's the good news. It's really just a language. That's all it is. And today we're going to learn the 5 key words that are the absolute foundation of it. Once you get these down, you'll be able to look at the market with a whole lot more confidence. Let's do this.
All right, first things first. Before you do anything, and I mean anything in trading, you have to ask one simple question. Which way is the market moving? This is called identifying the trend.
So what is the trend? It's just the big picture movement, the general flow of the price over time. I like to think of it like the current in a river. You'd want to know which way it's flowing before you jump in, right? Same thing here.
So you've got 2 main directions, and they're pretty self-explanatory. An uptrend is when the price is consistently climbing, making a series of peaks and valleys that are each higher than the last. A downtrend, you guessed it, is the exact opposite. The price is falling, making lower peaks and lower valleys. It's a simple pattern, but learning to spot it is one of the most powerful skills you can have.
Okay, but what if it's not really going up or down? That's the third direction, a sideways market. It's just choppy, messy, and unpredictable. And this is where some really solid advice comes in, especially for beginners. If you can't see a clear direction, the smartest move you can make is to just sit on your hands and stay out of it.
Now listen up, because this is a classic rookie mistake. It's all about perspective. You might be looking at a little 5-minute chart and think, aha, an uptrend. But if you zoom out to a 4-hour or a daily chart, you might see that the real powerful trend is actually screaming downwards. You have to zoom out to see the big picture.
Okay, so you figured out the trend. What's next? Well, the very next question is all about risk. How much skin are you willing to put in the game on this one trade? That decision all comes down to what we call your lot size.
To put it simply, a lot size is just the volume of your trade. It's how many units of a currency you're actually trading. Think of it like the gas pedal. It directly controls how big your potential profit could be, but also how big your potential loss could be.
And here's how that breaks down. You've got standard lots, which are a massive 100,000 units. That's for the pros. But if you're just starting out, your eyes should be right here on the micro lot. By trading just 1,000 units at a time, you can learn the ropes without risking a ton of money.
At the end of the day, it's a simple trade-off. A bigger lot size is going to amplify everything, the good and the bad. A smaller lot size keeps everything manageable while you're learning. See, controlling your lot size is controlling your risk. It's that important.
Okay, you know the direction of the market, and you've decided on your risk level. So, what do you actually do now? In the Forex world, you have 2 basic moves. You can either go long, or you can go short.
This is your game plan. If you spotted an uptrend and you think the price is going to rise, you go long. That's just a fancy way of saying you're buying. On the flip side, if you think the price is about to fall, you go short, which just means you're selling. That's it. Buy for up, sell for down. Simple. So you might be wondering, how do the companies that let you make these trades, the brokers, how do they make their money? Well, there's a tiny built-in cost on every single trade you make, and it's called the spread. So whenever you look up a currency, you'll actually see 2 prices. There's the bid price, that's the price the broker will give you if you want to sell, and then there's the ask price, which is what they'll charge you if you want to buy. And if you look closely, you'll notice the ask price is always just a little bit higher. And that tiny little gap between the buy price and the sell price, that is the spread. It's the broker's commission, basically. It's also the reason why every trade you open starts out just slightly in the red. You've got to cover the cost of the spread first. All right, last piece of the puzzle. Let's talk about what we're actually trading. Currencies always come in pairs, but the order they're in is super important. Let's break down how to read them. We'll use a super common example, the euro versus the US dollar, or EUR/USD, and let's pretend the price is 1.4000. So what on earth does that number actually mean? It all comes down to the order. The first currency, in this case the euro, is the base currency. It's the thing you're actually focused on buying or selling. The second currency, the US dollar, is the quote currency. You can think of it as the price tag. It's telling you how much one of the base is worth. So when you put it all together, that price, 1.4000, is just telling you how much of the second currency it costs to buy 1 unit of the first currency. In this case, it costs $1.40 to buy a single euro. Once that clicks, you can read any currency pair out there.
So let's do a super quick recap. Number 1, the trend is the market's direction. Is it going up or down? 2, your lot size is how you control your risk. 3, going long means you're buying. Going short means you're selling. 4, the spread is the small cost of making a trade. And 5, in a currency pair, the first one is the base and the second one is the quote. That's it. That's your foundation.
So there you have it. You now know the basic vocabulary. You could actually look at a chart and start to understand the conversation the market is having. So the question isn't what is it saying anymore. The real question is, now that you speak the language, what are you going to ask it first?